I don't know how to say this. Dear Wall Street.
Hey, this is Warren Redlick. I just watched a great interview with Gary Black on Dave Lee's channel, and I want to talk specifically about why Elon speaking doesn't connect with people like Gary on Wall Street.
Dear Wall Street.
This is not to blame Gary. I think Gary is a great guy, but he helps us understand how Wall Street thinks. We're going to break down what he says about how Wall Street thinks and show what they're missing about Tesla. Are you ready? Let's go.
Dear Wall Street.
Elon has a different way of thinking than we do. And it's not that people don't believe he can get there. It's just that that's not what the PM at Fidelity wants to hear about. He wants to hear about dominating the EV space.
So the PM is the portfolio manager at Fidelity, a large institutional investor. And he wants to hear about dominating the EV space. You know, Elon doesn't speak the way they understand. All of this is exactly what's going on here. Elon is not interested in dominating the EV space. There is no EV space. There's a vehicle space. And really, there's a transportation space. And what Elon was talking about has how the world is shifting to a world where people don't even necessarily own cars. And there's a lot of other details here that are going to come together here. But the idea that there's this EV space is this notion that doesn't really fit with where the vehicle space and transportation is going. And we're going to go in depth, cover a lot of little points here and there. But first, listen to how Dave Lee speaks about this.
What's the focus of Tesla? You know, I thought it was EVs and growing their market share and profitability. Right. But what's going on here? It's like, is Elon shifting focus to this like pet hobby project of some, fantasy robot that who knows how many years it's going to take, for it to actually come to product and to contribute, right, to profits and revenue.
There's this notion that Tesla has shifted from EVs to some hobby project. Now, the long-term focus of Tesla in the future is robotaxis and bot, but that doesn't mean they've forgotten making EVs. A lot of what they talked about is how they're going to make a lot of EVs and how that's going to continue for the next few years. This concept of the bot as a hobby project, first of all, so what? If bot never happens, but Tesla continues to grow the company, there's no big deal here. There's no announcement that Tesla is investing half of their cash pile into bot. There's $17 billion in cash, let's say. It's not like Tesla said, we're going to invest $8 billion in building a robot. They're working on it. They see that as a future. If it takes off the way they think it takes off, great. FSD combines with it, creates real-world AI, can get us there. But this idea that somehow it's a hobby project, first of all, no, it's a serious project. They're going forward with this, but it's not taking away from building EVs. They're building EVs at a breakneck pace. They're growing fast. That's not changing. They're building factories. They're building 2 factories now that are about to start. They talked about opening new locations for more factories. They're serious about building more cars. So it's unclear why they don't see that. I'm not trying to pick on Dave because I think Dave does get it. He's setting up a question for Gary. And it just shows the way Wall Street saw this was, wait a minute, why is Tesla focusing on a hobby project instead of focusing on building cars and selling cars? And let's listen to Gary Black talking about EV market share. I'm going to go into what he's got wrong here, but listen to what he has to say.
We haven't changed our estimates for 2022 through 2025. I'm as convinced as ever that EV adoption is going to continue to soar from where it is. It's about 6.3% in 2021. We have it going to 30% by 2025. So you got a built-in 50% volume growth if you do the math on that, if Tesla just holds its share.
So Gary has this notion, and I think this is common on Wall Street.
Dear Wall Street.
That there's an EV market and there's a vehicle market, and they're 2 different markets. And that as EV market grows, Tesla, as long as they maintain their share of that EV market, everything's great. And this is a completely different perspective from my perspective, and I think a lot of Tesla investors' perspective is there is no EV market. There's a vehicle market. Every vehicle Tesla has made, Tesla has sold. And the EV market was much smaller when Tesla started making vehicles. So basically what happens is every Tesla that is sold replaces an internal combustion engine vehicle, a gasoline or diesel vehicle. They don't replace other EVs. Very few people are trading in EVs to buy a Tesla. The vast majority of people who are trading in a car or getting rid of a car or replacing a car are replacing an internal combustion engine car, gasoline car. So this notion of the EV share is something that a lot of people on Wall Street are committed to. Even people who are more pro-Tesla, they're committed to this concept. And it's just the wrong concept. And then you take it further. If you go far enough down the road and you see FSD working in a robo-taxi network coming into existence, it's not really going to be a vehicle market at all anymore. It's not going to be a consumer-oriented vehicle market. It's going to be a consumer-oriented transportation market. And Tesla robo-taxis are going to be the vehicle of choice for robo-taxi transportation, basically replacing Uber and scaling up the size of that rideshare market, basically much, much bigger than it is today, because it's going to make more sense to rideshare than it is to own a car. And that's hard for people to wrap their heads around. We're not really going to get into that much in this video, but this concept limiting Tesla to a share of an EV market misses the current state of things, which is there is a consumer vehicle market, and Tesla's share is of the full vehicle market, not of a specific EV market that doesn't even exist. Next, we're going to hear Gary talking about what's coming in 2022.
People are questioning the PE that should be on earnings. So we're not changing our estimates. We're way ahead of the street. So for 2022, we're at $12.80. The street's up to about $10 now. They're up about 4% today.
Right here, the $12.80 and the $10, Gary is talking about earnings per share for the year 2022. That's what that $12.80 is. That's not a price target. That's earnings per share.
So 2022, and this is how you have to think about the stock. 2022 is baked, and even the bears are saying they're all taking their estimates up. I spent some time with Tony Sacconaghi, who I know for a long time. Who asked a couple questions just as Elon decided not to answer. He's very respected. He's a bear, but even he took his estimates up by 50% for 2022. You almost have to think about the stock as 2022 and then beyond.
Gary's explaining this perspective. So first of all, the idea that 2022 is baked. They have their sense of this is how many vehicles Tesla's going to produce in 2022, and I think they're low. Gary later in the video is going to say 1.6 million. I don't know where Tony Sacconaghi is. We know that Tesla has 2 new factories coming online. We know that Zach Kirkhorn, not Elon, said that they expect 50% or maybe more than 50% growth in 2022 from Fremont and Shanghai. If they only do 50% growth from Fremont and Shanghai, that's 1.4 million. And then anything that comes out of Texas and Austin adds to that. I think we might see 1.8 million. Because remember, they overperformed the 50% they said for 2021. Substantially overperformed the growth that they predicted for 2021 in a year where there were massive supply chain issues. They went from 500,000 to 936,000, an 88% rate of growth. So to expect they're only going to grow 50% in a year where we're expecting less constraints, I think is a misunderstanding. But I just want you to understand this concept of baked. Gary's going to talk about this baked concept again in the next clip.
The recurring earnings were about 280. If you just annualize that, that's 1120. Okay, yeah. So that's why people like Tony, who's a bear, taking estimates up pretty dramatically for 2022. The 2022 is baked. Everybody gets that.
Gary's talking about the earnings for 2022 and says it's baked. That if you look at what they did in fourth quarter and you multiply by 4, you just assume that they're not going to grow profits at all in 2022. Then you get to like $11.20 a share. Gary sees some growth and sees it going to $12.80 a share. I see more like $15, $16 a share for 2022 because margins continue to improve and we're going to see a lot more growth than they're seeing. To get only $11.20, you would have to assume that there's no growth from Q4, that they don't produce any more vehicles in Q1, 2, 3, or 4. Each quarter of 2022 is the same as Q4. Obviously, we're seeing significant growth. They're talking about 50% growth in revenue. And margins, generally speaking, profit per vehicle generally goes up as they scale production, as they grow. So what we're likely to see is not $11.20 in earnings per share for 2022 and not $12.80 per share for 2022. But if you saw 50% growth from $11.20, you would add $5.60. You would get to basically $17 a share. And then if you figure there's more growth and there's more margin growth, you might even get to $20 a share for 2022. So the idea that it's baked at $12.80 a share or $13 a share or $11 a share, no, with 50% growth, it's much higher because margins are getting better. As the business grows, there are certain costs that are fixed costs or that don't grow as much as the business. So the profit actually grows just by producing more vehicles. Shanghai produces at a higher efficiency, So Shanghai has higher margins, and Shanghai is growing faster than Fremont. Giga Texas and Giga Berlin, as they scale production, they're going to be more efficient. They're going to be higher profit per vehicle as well. Berlin opens up the European market, eliminating transportation costs. Gary talks about this later in the interview. Eliminates transportation costs, eliminates tariffs. So the margins that are gained from selling vehicles in Europe goes up. The margins that are gained in China, you manufacture a vehicle in China, now you sell it in China. You don't have to transport it halfway around the world. You save money there. So many different factors mean the profits are actually much higher than what Gary's talking about. And I don't understand why Gary doesn't seem to see that. I mean, he gives it a little bit more, up to $12.80, but we're looking at more like a minimum of $17 a share using his analysis, and maybe even $20 a share in 2022. And that leads to a much different price target. If you figure they're going to make $18 a share or $20 a share in profit in 2022, then you would come up with a much different price target than what you've got at $12.80 a share. Because you use the same multiple. If you're multiplying 1280 by 50, let's say, and instead you multiply 20 by 50, you get a much bigger jump. I think his price earnings ratio is higher than that, but just to give you a sense, earnings per share of $11.20 or $12.80, very clearly not baked into 2022. 2022 is going to be much bigger than that. Just really quick, I want to mention the Tesla is the next Tesla t-shirt. You can see the t-shirt over here. Tesla is growing really fast, and you can see right after the "You Are Here," which is when I made the shirt, there's a big drop in the stock. The stock goes up, the stock drops. You can see it again higher up on the graph that there are moments when the stock drops significantly. It's a roller coaster ride. So if you believe that Tesla is the next Tesla, that when you're investing in stocks and you're looking for what's a company that's going to grow really fast like Tesla did, Tesla's the companies that are going to grow really fast like Tesla did. Tesla's the stock that's going to grow really fast like Tesla did before. So if you're interested, please check out the t-shirt, Tesla's the next Tesla, at elonbits.com. And this is a big moment. Listen to Gary talk about the growth of Model 3 and Model Y and growth generally. And I want to come back and show you what he's got wrong here and what Wall Street has wrong here.
Stock is down so much is people are now worrying about 2023, 2024, 2025. How do you get to 50% earnings growth? And that was Tony's question, which Elon didn't want to answer. How do you get there? And of course, Elon said, well, you don't really understand FSD and, appreciate, I think he used the word. And so that long-term growth rate, do you believe they can get to 50% growth on essentially two models?
He's talking about Model 3 and Model Y. Those are the two biggest selling models that Tesla has. It's not just about FSD. Long-term, way long-term, Elon sees something very different. But the practical reality is, and this is something that I've been saying, and a lot of people respond to this, Gary is basically reflecting the idea that somehow Tesla needs more models in order to be able to sell higher volumes. You can't possibly sell that many vehicles of a Model Y-sized SUV and a Model 3-sized sedan around the world. They're going to need a greater variety of models of vehicles in order to sell, because there's a small sedan market, there's a small SUV market, there's a mid-size SUV market, there's a pickup truck market. He sees the world composed of these different markets. Now, I would just note that vehicles roughly the size of Model Y, these SUVs, are a huge share of the global market. There's room for a lot of SUVs. If it's the best SUV on the market, which it is, that's different. But the thing that's really struck me throughout this interview is this notion that somehow Tesla is going to need a lower priced vehicle, and Tesla's going to need these niche vehicles in order to be able to fill the niches. And it's a big misunderstanding of what the Tesla vehicle is. If you go back to the world of phones, you go back to cell phones, and you go back to the age of flip phones, and there's this wide variety of flip phones, and then Apple comes out with one phone, the iPhone. If you were sitting there at the beginning of the iPhone era saying, well, they're going to have to come out with more models of iPhone in order to be able to sell them, and they're going to have to come out with a cheap iPhone to be able to sell them. They can't possibly sell iPhones at these high prices. Can't possibly work. They can't sell a huge volume of them. And now people are paying $1,000 or more for a single iPhone. They miss it. It's a game changer. A Tesla vehicle is a game changer. It is a completely different animal from a car. Yes, you drive it to get from point A to point B, but it's so much better than a regular car. I'm driving a Tesla Model 3 for a few months now, and I can't stand driving a gasoline car anymore. It's so frustrating. The Tesla is that much better, just like an iPhone is that much better than a flip phone, and you're not going back to a flip phone. The potential growth for Model Y and Model 3, you can see the order backlog. You can see that there are markets they haven't even started to penetrate. There are countries where they haven't really started to deliver vehicles. But primarily, it's just the room for Model Y, Elon talked about 2023. In the past, Elon has said Model Y will be the best-selling vehicle by unit volume in the world in 2023, and that would replace the Toyota Corolla, which sells about 1.5 million a year. So if Model Y in 2023 is going to sell more than 1.5 million vehicles, and then Model 3 is going to sell a chunk, it's not that hard to get to much larger volumes of vehicles as you go out in the future. And yes, will they add some other vehicle in the future? Maybe. And of the world's SUV market, there's plenty of room for Model Y to sell 1.5 million vehicles if it's the best model, if it's the best SUV on the market. There's plenty of room for Tesla to sell a lot of Model 3s if it's the best midsize or compact sedan on the market. There's plenty of room. Inside, it's big inside. So there's plenty of room. It's not that big on the outside. It's big on the inside. Lots of room in the market, just as the market is today. If they're the best car out there, they're the best vehicle out there, the best SUV out there, the best sedan out there, there's plenty of room to sell a lot more of them. Going further down the road, when you say this is not just the best vehicle on the market, this is better than any other vehicle ever, and it's a completely different animal, it's like buying a smartphone. No one's going to want to drive a gasoline car when they can have a car that's that much better. That's just completely different animal, does so much more. You charge it in your garage instead of having to go to a gas station. You never have to replace the brakes. You never have to do an oil change. It's just a better experience. The mapping, the software, everything is just so much better than what's in a regular car, and Gary doesn't see that. And yes, FSD is a big deal in a lot of different ways. And, I don't know when Elon thinks he's going to pull a switch and everything's going to change with FSD. Maybe it's this year, maybe it's next year. And the Tesla team's on board with that progress. Gary's going to talk about FSD in this next clip. Listen to this.
99% of it is the EV business. And that's what the average portfolio manager is buying Tesla is thinking about. It's not that they don't believe in FSD. It's just FSD, we're a long ways away from having, level 4, level 5 autonomy where the robo-taxi can drive the kids to school, or you can, put it in the garage and it'll go out and take people for passengers and you can make money on it. We're still a few years away from that.
So first of all, I don't think Elon uses level 4 in his analysis. I never hear Elon talking about level 4, level 5. People ask him about it, but I never hear him use those words. I don't use those words either. What Elon talks about is when FSD drives better than human, when it drives safer than the average human, when it drives better than the average human. He talked about that in the investor call. He said the average human being safer or better than the average human is a low bar. Human drivers aren't that good. And he sees the progress. If you've watched his other interviews, I'm going to be doing a video soon with his Lex Friedman interview. When you look at how he talks about the progress of FSD beta in particular, it's going much faster than people realize. There's improvements under the hood that people don't see. My personal experience, it's not good enough yet, but it's not supposed to be good enough yet. By the end of this year, will it be good enough? Elon thinks so. Andre Karpathy thinks so. The Tesla team thinks so. I think it probably will be that good by the end of the year. But this captivation with this concept of the level system, it's an archaic system. It's not the way people who are really into the actual coding and developing of FSD think about it, about the way people who think about self-driving cars really think about them. Safer than human is a much simpler concept to understand. And I would, of course, say which human? So safer than the average American driver, maybe safer than the best American driver, safer than the best human driver. Those are all targets you can hope for. But right now, I think the goal is safer than the average American driver for the American market. And that's where they're headed. And I think we're going to get there by the end of this year. And Gary doesn't see that at all. He doesn't even think about it in that context, even though that's the context Elon talks about. That's one of those things. Elon talks about it in a certain way, and Wall Street doesn't even think about it in that way. And even though Elon's talking about it that way, and the rest of the team talks about it that way, the market can't hear that. Wall Street can't hear that. White people can't hear Jimmy, if you've ever seen that movie. White men can't jump.
White people, y'all can't hear Jimmy. You listen.
So Wall Street can't hear Elon. Next, listen to Gary talk about growth from 2023 into 2025. Listen to how he and Wall Street thinks about the years after 2022.
When you look at 22, everything looks great. Fourth quarter was strong. Everybody's estimates for 2022 are going up. Both volume estimates and earnings are going up. But people are not moving up the growth rates for 23 and 25 and beyond. And that's what Tony's question was, that Elon just didn't want to answer.
So first of all, I disagree that Elon didn't want to answer that question. Elon and the Tesla team did answer the question. Elon and Zach in particular did answer the question. Wall Street can't hear the answer. Number one, Giga Texas and Giga Berlin are coming online, and they're going to produce a huge volume of cars. And Gary's going to talk later about the conflict between the demand side and the production side. Elon and the rest of the Tesla team basically feel that they just need to produce more cars and they'll be able to sell every car they make. And Gary disagrees with that. He doesn't see it. I think Wall Street doesn't see it. To me, it's obvious when you have an order backlog as big as Tesla's is, when you look at the challenges that the regular car industry is having even making cars because of their supply chain problems, which are worse than Tesla's supply chain problems. People want to buy cars. They're having trouble buying any car. If Tesla can produce more cars, they can sell more cars. It's just that simple, especially when they're making the best cars on the road. And Gary would pretty much concede that they're the best cars on the road. I think he'll say that somewhere in this interview. So looking out into 2023, for example, well, Berlin and Texas won't be fully ramped until maybe the end of 2023, maybe into 2024. And Elon and Zach talked about that they're going to be looking for locations for factories this year, and they'll probably make an announcement this year. That means they're going to be building factories in 2023 for vehicles in 2024. And we are going to see Cybertruck in 2023. I think that's pretty likely that they'll sell Cybertruck. I don't know that there's any other high volume vehicles coming, and maybe there'll be variations of Model 3 and Model Y. The potential to sell huge volumes of the vehicles that they already have is underestimated by Wall Street, in my opinion. Now, you might buy their opinion. You might say, you know what? People are only going to want so many Model Ys. People are only going to want so many Model 3s. And I think if you think about the new car market, you say there's only this many sold, but think about how many people buy Toyota Camrys or Toyota Corollas and how many other Camrys and Corollas there are on the road already. And you're basically buying a clone of a pre-existing vehicle, where with Model 3 and Model Y, there aren't that many of them on the road yet because Tesla just got started. So I don't think the saturation of the new car market is as much of an impact on people's decision whether they want to buy a car that's like all these other cars, when there aren't that many Model Ys and Model 3s on the road already, where with Camry and Corolla, you've got 10, 20 years of these vehicles that are in the market. So it can feel more saturated, not to mention that Camry and Accord look a lot alike, Corolla and Civic. There's a lot of similarity between existing vehicles. You look at modern SUVs and they all look the same. So I just don't think it's that big of a deal. If it's a much better vehicle, it's a much better vehicle and people will take it, and they're not going to worry about, oh, I don't like, this form factor. I want this other form factor, so I'm going to buy this crappy car over here instead. I don't think so. Some people maybe, but most people no. Next, Gary talks about catalysts, what might drive the stock up in the next months through 2022. I think he gets some of it right, and I think he gets some of it wrong. Listen to what he says here.
There's a ton of catalysts that are still out there. Austin and Berlin are going to open. We don't know when. They didn't really talk about it on the conference call.
They did talk about it on the conference call. They said that Giga Texas will deliver vehicles in Q1, 4680 structural pack vehicles in Q1. I think they said that Giga Berlin would also deliver vehicles in Q1. I'm not 100% sure of that. We know they're both producing cars already. To say they didn't say that on the call, I think maybe Gary missed it. I'm not trying to fault Gary for it. It's a long interview. You're going to make some little mistakes here and there. It was a long call. You might not catch every detail. But to say that they're not going to deliver, we don't know when they're going to deliver cars, or they didn't say when they're going to deliver cars out of Texas and Berlin. They very clearly said they will deliver 4680 vehicles out of Giga Texas in Q1, and I believe they said they expect to deliver vehicles out of Berlin in Q1 as well. That's the first 3 months of the year.
Two, we believe that at some point S&P will raise Tesla up to an investment grade rating. I still think we're going to have an $8,000 EV credit at some point this year. And at some point, people will start thinking about Cybertruck again, but not now, because it's not going to happen until 2023.
So I think the investment grade rating, what happened, Tesla is considered a junk bond when the Wall Street bond agencies rate, when the Wall Street credit agencies rate Tesla, they rate it as a junk bond status company. And Gary's going to explain later that that's probably wrong, that if you look at Tesla's numbers, it probably should be a top-rated company in terms of its credit worthiness. So that's one catalyst, is at some point the rating agencies might bump Tesla up to investment grade, and that can lead to some portfolio managers saying, okay, now I can buy the stock now that it's investment grade. There may be some restrictions on some funds that they feel they can't buy the stock until it's investment grade. They can't buy stock in a company that's not investment grade, not rated investment grade by the credit rating agencies. The tax credit, I don't see it happening. People have heard me say that before. Gary thinks it's happening. Later in the video, he talks about they have some source who knows some of the Republicans and they think it's going to happen somehow. I don't think it's in the interests of the rest of the car industry for Tesla to get $8,000 a car. So Tesla's selling EVs in much higher volume in America than anybody else. The benefit of the $8,000 tax credit goes predominantly to Tesla. So it's not really to GM and Ford's advantage and Stellantis, Dodge's advantage for Tesla to get all these breaks and Tesla buyers to get all these breaks on buying Teslas. So I just don't see that happening. I don't think it's an important catalyst. I don't think Cybertruck is going to be a catalyst this year. Maybe there'll be an announcement late 2022 and maybe that'll drive it. I just think that what's really the driver that I don't know that Gary sees is when the 4680 Model Y starts coming out of Texas, it's going to be 500 pounds lighter than the existing Model Y. It's either going to be a lot faster or it's going to have a lot more range or both. And it's going to be a compelling vehicle. And auto industry journalists are going to drive it and they're going to be amazed by it. You're going to see YouTube videos about how amazing it is. And I think that is going to be a catalyst that people can't quite wrap their heads around is a Model Y, and they'll probably sell it as a high-performance model, be $75,000. This is another theory that Omar Kazi suggested, that they would sell it like another vehicle, and they would just software limit its acceleration and software limit its range. I think it makes a lot more sense to sell it as a more expensive vehicle. Plenty of people like me who will pay a lot for that vehicle if I can get it with the high performance and the longer range. A lot of advantages to that vehicle, and I think that will be a driver of the stock when people realize how great that vehicle is, and that's a mass market vehicle rather than like the Plaid S is so unaffordable it doesn't really matter, doesn't sell in high volumes. And the future of the Model Y, you can see how this new Model Y coming out of Texas, as they scale production, there will be lower cost versions of it that come out, and that's going to be another big driver of why Model Y will be able to achieve the high volumes that Wall Street thinks it can't do.
But he really needs to have somebody, and having a strong number two, which he doesn't have, or having Zach or Drew talk about, look, here's what we're doing with the base business. That would have been a much better way of running the conference call yesterday.
Well, he has this notion that there's no strong number two, and I think Drew Baglino is an extremely strong number two. I think Zach Kirkhorn is potentially a strong number two. These are two guys who know the business really well. Drew being on the engineering side, Drew being the guy who was up with Elon on Battery Day. There's a lot of quality people in Tesla, including Andrej Karpathy and Ashok, the Tesla Autopilot team. But really, if you look at Tesla's own website, they say that the three key people in Tesla, the leadership of the company, is Elon Musk, Drew Baglino, and Zach Kirkhorn. I talked to Drew Baglino in depth at the Plaid event, and I was very impressed with him. And I think anybody who talks to Drew, anybody who listens to Drew understands, Drew's pretty good at flying under the radar. You can see him once in a while, but people don't notice him. Zach spoke more at the investor call because Zach is the master of coin or CFO. But given that Tesla is an engineering-driven company, no one understands Tesla engineering better than Drew Baglino. No one. So Drew Baglino is the clear number two. He didn't speak much at the investor call because Elon was there. Zach Kirkhorn spoke extremely well. I'm consistently impressed with Zach Kirkhorn. He laid out a lot, and the fact that Wall Street doesn't get what Zach is saying either is a striking factor to say that, Elon didn't give them what they wanted. Zach said what they were going to do. Zach said they were going to grow production out of Fremont and Shanghai by 50% or maybe more, and that they were going to grow materially more or comfortably more than 50% in 2022. Zach gave them that. They disregarded it. To me, he's a strong voice. I thought he was very clear, and they just didn't get it. I just wanted to mention another context. I heard Gary talking about the credit rating agencies, and that one of the reasons they haven't bumped Tesla up to investment grade is the Elon risk, that because there's no strong number two, there's no obvious person to take over the company, and the sense that the company would flounder if Elon was gone, that's something that gives people hesitancy to invest in Tesla or to view in Tesla as investment grade. And I'll just say, I'm familiar with the Tesla team to an extent. I watch a lot of what they say. I watched Karpathy speak. I watched all of AI Day, Autonomy Day. You see a lot of very bright, sharp people working at this company. And I think you see great leadership from Drew Baglino, Zach Kirkhorn, the Autopilot team, etc. There's a lot of great leadership in this company, and people are massively underestimating the talent and the vision that permeates the company. The vision is baked in, actually. It's not just that, the engineering, the focus, the way we do things. When they were asked this question about having an incubator, they're all laughing. We innovate on the factory floor. They get it. The team gets it. It's not just one guy. Elon's huge. Elon's really important. But Elon's spending a lot of time at SpaceX. Elon's spending time with Neuralink. He spends a lot of time at Tesla, but he spends a lot of time at SpaceX too. Drew Baglino's 100% Tesla, maybe 120% Tesla. Zach Kirkhorn, again, 100, 120, 150% Tesla. These guys are deep into the company. They're working. They know how this company works. And I'm going to almost guarantee you that Tesla has a succession plan that makes sense. And the idea that they don't have it is probably a mistake. A lot of what Gary talks about involves modeling. That I do this on my channel where I come up with models of how I think Tesla's going to do with a certain approach like bot or like robotaxi. And Gary talks about how Wall Street models things, how he models things, and the way they model things is different. And I think this is one of the things that they miss is that it's not that hard to model because I'm not that special and I can model robotaxi. I'm not that special and I can model bot. Stephen Mark Ryan does similar models to mine, I think. It's almost like napkin math, but you do a little more. You can put it in a spreadsheet if you want to, but the way they model, he's basically showing the limitations of Wall Street that they don't see how to do models. But listen to how Gary talks about this.
Look, analysts and PMs model. They build forecasts, okay? They don't just pick a price target out of thin air and say, okay, I think Tesla's going to, they have to come up with a forecast. And so, when I see what you do. I mean, I do stuff like this, okay? This is a pretty long spreadsheet, and this summarizes into this. And if I'm a portfolio manager at one of these shops that owns it, and I'm an analyst, I've got a 10-sheet spreadsheet that feeds into a summary sheet. And so you can do that with EVs. You can do it by market. Most people look at it US, they look at China separately, they look at Europe separate, and then they take the rest of the world. I look at it as EV adoption times EV share times SAR, and that gets me a units number. And that's what I'm sure most people do.
There's a lot to unpack there, but basically they have their way of modeling Tesla, and you could hear him talking about EV market share. Again, I don't think that's a sensible way of modeling Tesla. I think the demand is effectively unlimited, and it's just a question of modeling production and roughly what they can sell their vehicles for, what kind of profit they're going to make per vehicle. I don't think there's any concerns about Tesla being able to sell more vehicles. If not anything else, they can just lower price and they'll greatly increase sales, but they don't even need to do that.
It's range, it's power, meaning 0 to 60 or 0 to 100. It's the technology and it's safety. Those are the four things people look at when they're choosing an EV. We know that.
So again, you can see he talks about what people are looking for in an EV, ignoring the fact that people are choosing between internal combustion engine vehicles and EVs. Almost every Tesla replaces an internal combustion engine vehicle. There are a lot of people who are out there thinking about buying a new vehicle, and they might have, if it wasn't for Tesla, they would have bought a gasoline-powered vehicle. There aren't enough other EVs out there for people to buy, and they might not buy them anyway. But because Teslas are so good, people are replacing gasoline engine vehicles with Teslas. So I think Gary misses something there, but let's go on.
And so on those dimensions, Tesla, you can think about that, and you could think about each of the segments it's in. So you could look at the percent that's sedans, the percent that's pickups, the percent that's under $25,000, the percent that's small SUV, and you can multiply it times the share and you can come up with a number. And so if I'm an analyst or a profile, I'm very comfortable doing that for Tesla. Okay, now let's talk about how do you do that for robots. Mm-hmm. There's no numbers out there. I don't even know what Tesla's distinctive competence, to use an overword marketing word, is going to be in robots.
You notice at first, Gary talked about how you model by looking at different market segments. So you have small SUV, you have pickup, whatever, and you think about what the share of those markets are, ignoring the fact that the share of those different segments can shift, as we've seen a massive increase in SUVs in the segments. So you'd have to model that as well. How are the segments going to change? Model Y is so good that more people are going to buy SUVs over other vehicles. That's something that he didn't address. But the idea that you can't model bot, you can model bot. The fact that Gary doesn't understand how you might model bot is an interesting point. And listen to more about that next.
Okay, now let's talk about how do you do that for robots. There's no numbers out there. I don't even know what Tesla's distinctive competence, to use an overword marketing word, is going to be in robots. I mean, I think they have a good brand for it, but I don't know the size of the TAM. I don't know what segments they're going to go after. It sounds like they can go into factories and try to find ways to replace workers maybe with their bots, but it's not. It's like Tesla going into restaurants. Okay, it's just, yeah, maybe they could do it and they could put them near their charging stations, but there's no distinctive competence. And I don't think the average portfolio manager could put together a model that would say, here's how I would value that business. And so people always make fun of my numbers. They say, well, you don't include anything for energy and you don't include anything for insurance. and you don't include anything for robotaxi. And it's not that I could do it. I could put numbers together, but I'd be just making them up.
So there's a couple things to unpack there. One, he doesn't see that Tesla has any special competence in the area of robotics, and he's missing a couple of things about Tesla at least. One, they're extremely innovative. It's an extremely innovative company. We can all see that. They got the best engineers in the world, so they got a lot of engineering talent. Elon consistently talks about manufacturing as being Tesla's core competence. Their number one strength is manufacturing. If you're going to manufacture robots at scale, you want to be really good at manufacturing. People are always talking about Boston Dynamics. Oh, they have these cool robots. They're not manufacturing them at scale. And the other core competence that they're missing is FSD, real world AI. The ability to perceive the world and navigate the world around you is something that's very important for robots to do. And other robots can't really do that. And Tesla already makes robots that do that. They're called cars. They're on wheels. And you're just taking the same software and hardware that allows you to visualize the world, convert the world into a vector space, navigate that vector space, perform actions in that vector space, perform actions in the real world like pick up that object or make that left turn, accelerate, brake, move forward faster, move slower, pick something up is something that robots are going to do. The FSD that's at the core of the self-driving cars that Tesla's building, that same FSD is going to help robots, Tesla's robots, navigate the world. No one else has that. No one else has the manufacturing competence that Tesla has. No one else has the engineering competence that Tesla has. To say that Tesla doesn't have any particular competence for this totally misses it. Regarding the total addressable market, the TAM, as Gary referred to it, he says, well, they can use them as factory workers. Look, you don't have to have sophisticated models. You can do things with napkin math. SpaceX came about because Elon did napkin math on an airplane. Coming back from Russia, he said, we can build rockets ourselves and we can make this work. Napkin math can be very powerful, and you can make it a little more sophisticated than that. But fundamentally, they're missing what bot does. And I think I got it. Maybe I'm wrong. I think Dave Lee gets it. I think Stephen Mark Ryan gets it. It's if you look at bot and you say, okay, what are some routine tasks that humans do that are either boring or repetitive or dangerous? That's how Elon put it. Maybe it's taking out the garbage at Burger King. Maybe it's cleaning up human waste at a nursing home. Maybe it's installing solar roof tiles on roofs, which is dangerous and it's repetitive and it's boring, whether it's solar panels or solar roof tiles. There's a lot of different tasks that humans do. And it doesn't have to replace a human at his entire job. It can replace some of the work that a lot of different workers do. And if you have 10 guys at a Burger King and you're able to replace one of those guys on 2 shifts because the bot works 2 shifts, you can model that. Gary hasn't tried to model that. He hasn't thought it through to say, how would this work? That doesn't mean you can't model it. It just means you're not thinking hard enough. I've got a model of that on my channel. You can check it out here. I'm pretty sure that Stephen Mark Ryan and Dave Lee have talked about it at least, and they may have models. It's not that hard to model. It takes effort, but it doesn't fit in their models. They don't have pre-existing total addressable markets for robotics, so they can't see it. It's the labor market. Elon talked about that. It's the labor market. They're replacing labor, and we know what the labor market is, so you're just replacing human labor, and it starts with very simple tasks that the bot is initially trained to do very simple things. Like I did a poll on Twitter, how about patrolling the perimeter of a property? Replacing a security guard who's going around the perimeter, and that security guard falls asleep, that security guard isn't that careful, that security guard doesn't have 360-degree night vision, right? The bot does. So there's a lot of different tasks that a bot might be good at, and you just have to start thinking, okay, what will it be? It'll start with something simple, and over time, as the FSD gets better, as the artificial intelligence gets better, the real-world AI and the training gets better, they'll be able to do more and more tasks. Dave Lee clearly gets it. Gary clearly does not. Wall Street clearly does not. Now, when will it happen? I think performing simple tasks just isn't that far away. Something like patrolling the perimeter of a property. You got to be able to walk. You got to be able to see. They're probably going to have a wireless connection to a central space. And you got to be able to recognize when something's out of place, something different happens, which is something that FSD does when it's driving down the road. So that's an example of a fairly simple task it should be able to do. Mopping floors, moving objects from point A to point B. These are all fairly simple tasks that it should be able to do fairly early on. I think people think it's going to be harder than it is, and they underestimate Tesla's engineering team. They underestimate Tesla's autopilot and Tesla Vision team. It's coming fast. And you can model it, you just have to try. Next, Gary talks about taking the $25,000 car out of the models. I'm going to talk about this in some depth next. But listen to what Gary says first.
When you're an analyst, again, pretend I'm a Fidelity analyst, and I've got all this money behind Tesla, immediately what happens is the analyst has to take out their model, and they basically have to take the $25,000 volume out of the model or push it back. Okay. And it's the same thing with Cybertruck. Cybertruck, we don't know when it's going to come. I still have it in my 23 model, but I don't have it at the beginning of 2023. I have it more in the middle. But for a $25,000 car, you got it. And the PM's going to say, just take it out. I don't want to deal with it anymore.
Problem there is if you take the if you were modeling Tesla and you're saying, okay, they're going to get this many vehicles from Model Y and Model 3, and then they're going to have this other model, the $25,000 model, and this is going to generate a lot more volume. You take that out, then you're losing all this revenue and profits that you thought were coming in 24, 25, whatever. And I think that misses that. Number one, it misses that Tesla doesn't, they figured out we don't need a cheaper car. Just like Apple didn't need a cheaper iPhone, Tesla doesn't necessarily need a cheaper car. I do think that the $25,000 model will come eventually as you're trying to push the price per mile of a robotaxi ride down further. It may make sense, but Elon seems to think he can drive the price per mile of a robotaxi ride down to maybe 20 cents a mile with Model Y and Model 3. Kathy Wood thinks it's 25 cents a mile. I think it's going to be a long time before they get there, and I think a less expensive model will make that more viable. A less expensive, more efficient model will make that more viable. This idea that you're just taking the $25,000 vehicle out of the model and that's it misses that there's value. What you have to do is you have to recognize that Model Y and Model 3 are ramping faster than you thought, to larger volumes than you thought, at higher profit margins than you thought. So I think that misses a little bit there to just take it out of the model and not think further about it. Related to that point, this is one of those things where Gary and I agree a little bit. Gary's going to talk about how the $25,000 model might cannibalize Model 3.
The $25,000 car is not so much of a shock to me because, again, you've got to assume some cannibalization of Model 3. So I don't assume that they bring it out. It's all incremental volume anyway. I always assume 60, 70% of it comes from Model 3.
I agree with Gary that in the long run, if they come out with a $25,000 model that's much more efficient than Model 3, I don't think there's a lot of room for Model 3. And I think there may be a calculation within Tesla. Look, we can make a lot of money on Model 3 without replacing it with a compact. They redesign Model Y. If they redesign Model 3 with front and rear castings, structural pack 4680, or lithium iron phosphate and some sort of re-engineering with front and rear castings and lithium iron phosphate, they may get the cost of that vehicle down low enough that the $25,000 vehicle they were thinking of doesn't really save them that much money. And they already have the lines in place to make the Model 3. It's already a great car. I'm driving one. It's fantastic. So maybe there's no point in coming out with another vehicle. I still think they'll be able to do much better with a future vehicle, but there's no hurry to do it because they've got this room to ramp these vehicles. And it's another point that because of the supply chain constraints, because there aren't enough chips, because in the future there may not be enough batteries, there's not much point in coming out with new models if you can sell every Model 3 and Model Y you can make. Now listen to Gary talk about the potential for Model Y in Europe and how he sees long-term growth for Model Y in Europe. I think he gets something wrong here, but listen to this.
Taking Model Y into Europe and becoming the best-selling product in Europe over the next few years, because now you're making it in Germany, you don't have to pay 10% import tax, you don't have to pay to ship it. And it can get to be the best-selling product in Europe. And, maybe there's some different ways to have a Model Y in Europe that, the Europeans like better, maybe smaller, maybe, more hatchback-like. So that's one topic. And again, I think people were shocked because they don't know how to get to 50% volume growth after 2022. So from 23, 24, 25, in order to justify the multiple the Tesla was trading at, so it's come down, you have to show me that you can get to 50% growth. And Elon just didn't want to answer the question.
Now, again, I don't agree with that. I think Elon did answer the question. They just can't hear the answer. But this point that Gary makes, one of the things I think he gets wrong is this idea that in order to sell a high volume of Model Ys in Europe, they have to make it smaller or more hatchback-like. You can't make it more hatchback-like. It's already a hatchback. That one was kind of confusing. Look, they're building this factory. They already have the plans for how to build Model Y. They're not making a smaller variation of the Model Y or a more hatchback variation of the Model Y. The Model Y sells in huge volumes in Europe when they get it there. They're not going to have a problem selling Model Y. It's not that much bigger than Model 3, and Model 3 sells well in Europe as well. The challenge is selling in Europe is getting vehicles there at relatively low cost, which Giga Berlin solves. So Model Y will become the best-selling vehicle in Europe because it's going to be the best vehicle in Europe. It already is the best vehicle in Europe. And the Giga Berlin Model Y, especially when it goes to 4680 structural pack, will be far and away the best vehicle in Europe. They're going to sell plenty of them. They're going to sell as many as they can make. And no matter how hard it is for Wall Street to accept that, that's what's happening. Next up, listen to how Gary talks about full self-driving and take rates, which is the percentage of buyers who buy a Tesla. This was a question that came up in the investor call, and Elon, I thought his answer made a lot of sense, but the analyst didn't get it, and I think Wall Street generally didn't get it, and Gary shows that here, that he didn't really get it either.
And, you can see that FSD take rates are down to single digits now globally. They're mid-teens in the U.S. They keep going down, and now we're raising price to $12,000. And what Elon is saying is, I think, is that will turn around once we broad release it, once we get to level 4. Everybody's going to have to own it. And I don't think people disagree with it. I think what people are disagreeing with is you can't necessarily charge for it, and this is key, if 5 or 6 competitors have an equivalent product.
This is one of those moments that just makes no sense. The idea that 5 or 6 competitors are going to have equivalent FSD, they're going to have an equivalent product FSD. I don't know where Gary's getting this from. It makes no sense to me. The idea that Waymo or Cruise or some other companies are going to have some great version of FSD of their own that's going to compete with Tesla's, there's so many things wrong with it. We're going to talk about that more, but listen to a little bit more about what Gary says about that, and then I'll talk more about it myself.
So Elon was almost not belittling Tony, because that's too strong a word, but saying, you can't just look at FSD as just another feature. Remember we said that on the call? Mm-hmm. But I think a lot of analysts and PMs do think of it as a feature, because the basic product is driving from point A to point B. And yeah, if you cannot look at where you're going, you can play games, you can read, you can do other things, that adds to the utility of the car. And I think people all get that.
No, they don't really get it, because it's not just that you can sit in the car and not pay attention anymore. It's that the same car can do 5 times as much work. Instead of driving 2 hours a day, the car can now drive 10, 12 hours a day. 5, 6 times. I think the car can drive 16, 18 hours a day and do 9 times as much work as the average car does today. And that's the utility, that if the car lasts 1 million miles instead of 150,000 miles, and if the car is able to drive that much more volume on a given day, that's a huge value add to the vehicle that Gary pretty obviously does not get. And Wall Street, I'm not trying to pick on Gary here. I think Gary is doing us all a service by showing us how Wall Street thinks. But that's the thing they miss. And Elon very clearly said that in the call. He said it at Autonomy Day. He said it at AI Day. This is something he said repeatedly over the years. And Wall Street can't hear Elon. Like Stephen Mark Ryan gets it. Dave Lee gets it. I get it. Jason DeBolt gets it. A lot of us in the Tesla community get it. And Wall Street just can't see it. They won't see it until it's already happening. It's so obvious. ARK Invest gets it. But they don't get it. They don't see it. They just don't see the added value of a vehicle that can drive 18 hours a day. It doesn't process for Gary when you hear that it's going to drive 18 hours a day or 12 hours a day and do a lot more work, and that makes it more valuable.
But I think what most people in the institutional world believe is others are going to be able to do the same thing, whether it be Waymo or Cruise or Mobileye. Others will be able to come to that same product package where you can actually have the car drive itself. And then, look, you can look in California and see who's already approved for autonomous driving. There's like 7 manufacturers already approved they have to be level 3, level 4 to be able to test autonomous driving. Tesla's not even in that group. They're still level 2. So you could say, well, that's geo-fenced and everything, but I think that the skills are out there, the technology is out there. And again, dumb portfolio managers like me who are financial people and may not have an engineering degree, I think we look at it and say, well, look where we are so far. So it's very hard for a lot of us to say Tesla's going to have such a monopoly on full self-driving that they can charge, some of the numbers that get tossed around out there, $1 a mile. I think Elon actually said 20 cents a mile. So if you drive 15,000 miles, that's 3,000 a year.
Not 15,000 miles. It's 100,000 miles a year. Elon laid that out on Autonomy Day, and they just don't see it.
Still a big number.
Yeah.
And so the question is, will competitors charge that same amount, or will they charge less, or will they build it into the price?
Yeah.
And so it's hard for me to put a value on that because I don't believe they're going to have a monopoly on full self-driving.
So there's a lot of things that Gary misses here. And I was in a clubhouse room yesterday, and Gary participated. I give him credit for participating and listening to other voices. The other companies that are working on self-driving, number one, they're nowhere close. They don't have the volume of data that Tesla is generating. Tesla has like 2.5 million cars on the road that are sending data back to the mothership. There are 60,000 cars in the FSD beta trial now that are the cars are driving themselves and sending information back, and the AI training system that Tesla has is much better. And Gary just doesn't, like he said, he's not an engineer. He's a dumb portfolio manager, his words. And I don't think he's dumb. I think he knows he doesn't know. To give him credit for that. He knows he doesn't understand this. But I don't think it's that hard to understand the difference. And one of the key differences, if Tesla delivers FSD second, if somebody else actually delivers a fully self-driving car first, but there's only 100 of them, what does it do? With Tesla, they just do an over-the-air software update, and the 2.5 million cars that are on the road today are all of a sudden full self-driving robo-taxis. Nobody else has the volume. I don't think anyone else is close to delivering self-driving cars. Just because California government approved you for an autonomous driving trial in a very limited area, that doesn't mean anything. I drive FSD beta everywhere. Last night, downtown Miami, pedestrians, all kinds of crazy stuff going on. FSD beta is great. I've done it a couple times in downtown Miami in pedestrian areas where there's high drunk pedestrians walking around. I've done it on Halloween with kids walking on the street around. I'm supervising, I'm making sure it's safe. They've had 60,000 vehicles in this beta trial now, and they've had 0 crashes. It's fantastic. With human supervision, just to be clear, with human supervision, 0 crashes. It's making really good progress, and nobody else has the AI training, the AI inference chip, all the features that Tesla has going. Nobody else has what Tesla has, so they're not close, and they don't have the volume of vehicles to put it in, and they don't have the cost. So because Tesla's made this a low-cost system with 8 cameras and their own chips, they're going to be able to deliver it at a price point of maybe 15 cents a mile. Waymo has to charge at least $2 a mile to even break even on their vehicles. They might have to charge more than that. Nobody has a system where they're able to make a low-cost vehicle, because the Waymo vehicle is like over $100,000. It doesn't last that long. It uses a lot more energy because it's not really a true EV, or it's not an EV at all. Its LiDAR system is bulky and ugly. There's all kinds of things wrong with the other approaches that Tesla is better than. And that's what enables Tesla to deliver robo-taxi rides for so much less than anybody else. Nobody else has a low-cost system for doing it. I appreciate Gary for spelling it out the way he does so we can see what we see that they don't see. And this explains why Wall Street doesn't get what Tesla's doing. Just turning back now to the $25,000 battery day, what I call the battery day vehicle. Gary says it's coming eventually. Listen to how he talks about that.
Do you think they will do a 25,000 or cheaper car?
You know, when they have another 2 gigafactories up, when, you know, the supply constraints ease, when there's enough batteries out there that you know, they don't have to worry about, you know, the battery capacity, when 4680s in all their, maybe they use 4680s in all their bigger cars. I think at some point they'll basically reach back down into the compact space and say, we want to have a car in every segment. And that's the way they grow their EV share. And, you know, that's the way they get to, you know, I'm using 5 million vehicles in 25. I know, you know, I think Elon said 10.
I don't remember Elon saying 10 million vehicles in 2025. I'm getting in that ballpark myself. I don't know that I've heard Elon say it. I think the notion that the battery day vehicle is something that's to be sold to consumers in the, you know, subcompact market or whatever, I think misses the point. Elon has said that if they go that route with that vehicle, it's going to have no steering wheel and no pedals, and it's a purpose-built robo-taxi. This is not a vehicle that's designed to be fun for consumers to drive. It's a vehicle that's designed to deliver low-cost transportation to people, to replace buses, to replace trains, to replace subways. It's going to create a huge problem with traffic, and like Wall Street didn't pick up on Elon's point about traffic either. You don't hear Gary mentioning at all, if you massively lower the cost of trips, you increase the number of trips and the roads get crowded. Wall Street missed that one. I've talked about that one. Elon mentioned the Boring Company in the investor call. You know, Wall Street didn't catch that at all. You know, Elon sees it, the Tesla team sees it, the Tesla community, people like Stephen, Mark Ryan, myself, Dave Lee, we all see it. Gary and Wall Street don't see it. And again, credit to Gary for showing us how he sees things, because it helps us understand them. Now, quick here, there's a lot of talk in the Tesla community, who are people, the investing community, who are talking about macro factors affecting high PE companies, fast-growing companies. And I think this shows something that Wall Street really misses, and a lot of other investors really miss, is the idea that when there's an economic crisis or when there's macroeconomic problems, then a fast-growing company like Tesla is a less sensible place to invest your money. And I think that would make sense if the company was unlikely to grow as quickly because of the macroeconomic factors. And what we saw in the last 2 years in a global crisis, in a sense, was Tesla grew faster than anybody else. Tesla actually grew very, very fast in a challenging economic environment. So the idea that somehow the macro environment is going to make it hard for Tesla to continue its growth, great companies grow faster in crisis. Weak companies falter. That's what the regular car companies did. They faltered. They're not able to produce cars. Tesla's been able to grow their production in the face of that kind of crisis. So if there's some other kind of macro crisis, Tesla's still making the best cars. They're going to grow their share more. They're going to grow more in that crisis. They're going to do better in that crisis. And that's something I think they just completely miss. Gary's going to talk about Shopify. Shopify and Tesla are completely different animals. But listen to what Gary says.
If people worry about recession, you get risk off where everybody says, I'm not going to own high PE stocks if there's a chance we're going to go into recession. So if you look at a Shopify or you look at NVIDIA, you look at anything with a very high PE, Shopify is a great example because it's a wonderful company, great fundamentals. It's trading in the 800s now because it's very long duration. The ultimate long duration stock is Bitcoin because there's no earnings. So, people are trashing anything that's long duration.
The thing here is it's not just that Tesla has great fundamentals. Tesla has this massive growth prospect. I don't know anything about Shopify, and I don't see how Bitcoin relates to this. Tesla's growth is based on the fact that they're making better cars than everyone else. And they're building new factories to build more. And I think one of the concerns in a macro situation is when you have high growth companies that need capital, that they need more capital, they need to borrow money from the markets, or they need to do equity funding in the markets. If there's a recession, the money dries up. Tesla doesn't need that money. Tesla is profitable. Tesla has a big cash pile. So they're not going to be affected by some sort of economic crisis that freezes up capital markets. Like Lucid Motors might be affected because they don't have enough capital. Rivian actually has a lot of capital, so they're okay. Tesla not only has a lot of capital, they have a lot of free cash flow. They're generating positive cash because of the success of the vehicle sales and everything else that's going on with the company. So they're not really affected in the same way as a fast-growing company that doesn't have enough revenue and isn't making a profit yet. Those companies are in trouble in a recession, not a company like Tesla. Okay, so this is the last clip coming up, but I want to remind you about the Tesla's the Next Tesla t-shirt on elonbits.com. Plenty of other t-shirts, the Tesla Nair shirt, the stainless steel water bottle. There's lots of great stuff. Two different stainless steel water bottles. There's a Tesla one as well. Please check it out on elonbits.com, but let's listen to more from Gary about estimates and his price target.
Our earnings estimates are the same because our volume estimate for 2022 has been 1.6. And now what you're seeing is the street is catching up. Street is up 4% today. And so the earnings number we were using associated with 1.6 million deliveries is $12.80. The street's moved from $9.50 to now above 10. Probably will go higher. Okay. But that's what drives price targets. And that feeds into 2023, 24, 25. And I don't see myself, unless EV adoption, so I look at things from a demand standpoint, as do most institutional portfolio managers. I know Elon likes to talk about from a production standpoint, but to your point, a lot of other companies have said, oh, this is what we can produce. And you really have to think about both. You got to look about production and you got to look at demand. And so from a demand standpoint, to me, it's always SAR, global selling rate for autos, whole industry, including pickups, times the EV adoption, which last year was 6%, which means we've got 94% to go, times Tesla's EV share. That gives me units. Okay. And unless I change that, or unless I dramatically ramp up the pricing, or if I dramatically ramp up the gross margin, or if I dramatically ramp up the operating leverage, so you got fixed cost in R&D and SG&A, the price target shouldn't change unless you're going to change any of those.
What Gary's saying, and a lot of that makes sense, is you don't necessarily see profits going up that much per vehicle. It goes up some, but not that much. You really have to tweak the numbers. Unless you can get the volume of vehicles sold a lot higher, it doesn't work the way they model it. They're not modeling FSD. They're not modeling robotaxi. They're not modeling bot. We get all that. But even on just vehicle growth, he mentioned that EVs are 6% of the global market. That's 94% left. That's room for basically 20x growth. Tesla has plenty of room to grow to attack the other 94% of the market that is non-EVs. And of course, the market as a whole should grow over time. Unless, of course, we shift to a robo-taxi world, which changes everything, but they're not modeling it that way. So there's lots of room for Tesla to grow. Wall Street doesn't get it. I want to thank Gary for speaking with Dave Lee. I want to thank Dave Lee for doing that interview and publishing it on YouTube. I'll put a link to their video in the description below. Gary talks like you can't model some of the things that Tesla's doing. You can't model robo-taxi. You can't model bot. Check here for just one of my models about robo-taxi. Check here for my model about bot. As always, check out the t-shirts and the stainless steel water bottle at elonbits.com. Please support me on the Daily Live, my channel on the Locals platform. Support me on Patreon. Please join the YouTube channel as a channel member. And thank you so much for watching.